In crypto, a trap wrecks portfolios, even Sui investors. It's not bad code. It's not hacks. It's something psychological, mathematical. A deposit hits the account. Dopamine surges. We feel richer, safer, and start taking bigger risks without noticing. A quiet smile forms as the app glows. Confidence hardens. This is unit bias already steering decisions. It's called unit bias. In Sui, a $1 token tempts dreams. 10, 20, 50. But what if the path to those numbers is blocked? Not by technology, but by supply? What if the biggest threat to your wealth isn't adoption, but the mathematics engineered behind the scenes? For years, crypto has searched for the Solana killer. Many point to Sui. High throughput, low latency, safer than Solidity. Sui claims all three. Sui enters with elite engineering pedigree and move-based architecture. But we're not here for hype. We're here for one question. Can Sui realistically make you a millionaire in 2026? Or will its own tokenomics quietly suppress the price before it ever takes off? For any asset, the relationship between supply and demand dictates its price. But for many new cryptocurrencies, there's a hidden variable that can silently sabotage an investor's position. With SUI, this variable presents a formidable obstacle: the inflationary cliff. It's a structural challenge baked directly into its economic design, one that every potential holder must understand before committing capital. To grasp the scale of this challenge, we start with one critical number. As of late 2024, only about 37% of the total SUI supply is actually circulating in the open market. This is the portion that you or I can buy and sell on exchanges. That means the other 63%, over 6 billion tokens, are still locked away, held in digital vaults and subject to a predetermined release schedule. They are waiting. This isn't a random process. Every single month, a new wave of these locked tokens is released onto the market according to a strict vesting schedule. These unlocks flow to specific groups. Early investors who funded the project at a fraction of today's prices, the Sui Foundation for Ecosystem Development, and community reserves. While not all will sell immediately, their incentive is to eventually convert these tokens into profit or operational capital. This predictable, recurring event creates a consistent and silent downward pressure on the price. It's a constant headwind that the market must fight against. Imagine trying to fill a bucket with water, representing the demand needed to raise the price. But as you pour, the bucket itself continuously expands, representing the growing supply. You have to pour faster and faster just to keep the water level from falling. This is the economic reality for SUI. For the price to simply remain stable, let alone increase, new demand must constantly outpace the flood of new supply. This is the hidden tax of high, fully diluted valuation tokens. The current price might seem reasonable, but the market is already pricing in the value of all 10 billion tokens, even those that won't exist for years. You're paying for a future that is not yet guaranteed. So, does this tokenomic structure mean SUI's price is doomed to fall? Not necessarily. But it does mean that for the price to appreciate significantly, the demand for SUI can't just be strong. It must be nothing short of explosive. The question is, can the ecosystem generate that level of demand? But what if the tech justifies the inflation? Most chains process transactions like a single-lane road, one at a time. Sui processes transactions in parallel, a multi-lane superhighway. Its object-centric model allows independent assets to move simultaneously. This unlocks gaming, high-frequency DeFi, instant settlement environments. And if Sui becomes the standard for scalable Web3 apps, demand could create a price floor strong enough to absorb supply. Let's model the scenarios, starting with the bear case. In this future, the crypto landscape doesn't consolidate around a single winner, but instead splinters. Liquidity fragments across dozens of competing Layer 1s and Layer 2s, creating a high-friction environment where no single chain achieves critical mass. In this world, established networks with strong brand recognition capture the lion's share of attention. Solana, with its proven speed and low transaction fees, continues to dominate the retail and consumer-facing application space. Meanwhile, Ethereum solidifies its position as the institutional settlement layer, successfully scaling its ecosystem through a mature and diverse network of Layer 2s. The network effect is simply too powerful to overcome. This leaves Sui in a precarious position, a marvel of engineering that is technologically advanced, but critically underutilized. Its parallel processing capabilities go largely untapped as developers flock to more established ecosystems with deeper liquidity and larger user bases. Compounding this problem, the relentless token unlocks continue on schedule, month after month. This programmed inflation introduces consistent heavy sell pressure into the market. With developer and user adoption failing to accelerate, organic demand stalls. The new supply from unlocks is not absorbed, creating a persistent downward drag on the price. Under these conditions, in 2026, a repricing to the 35-cent range becomes realistic. And it's crucial to remember the context of early investors. Venture capital funds entered at fractions of a penny. At 35 cents, they're still realizing significant profit. The average retail buyer who entered above $1 is not. Now, let's consider the base case. This is the scenario of steady, methodical execution. Here, Sui doesn't need to win the blockchain wars outright. Instead, it successfully carves out a meaningful niche, capturing approximately 5% of the total smart contract platform market share. This growth is driven by tangible adoption, particularly in high-throughput sectors where its architecture shines. Gaming adoption increases as a few key titles gain traction, showcasing the benefits of Move's object-centric model for complex in-game assets. On the technical front, the Mysticeti upgrade delivers on its promise of massive scalability and near-instant finality, making the network a viable choice for enterprise and DeFi applications that require high performance. In this scenario, the network's fundamental value grows, supporting a market cap of around $15 billion. This translates to a token price in the range of $1.60 to $1.80. The outcome is respectable. It represents solid capital preservation and a modest gain against a challenging market. But for many, it's not a life-changing return. We've analyzed the technology, the team, and the tokenomics. Now, let's engage in a thought experiment. Let's remove the perceived limits and explore the absolute bull case for Sui. In every market cycle, capital seeks a new home, a new narrative, a new technological leader to crown. The question isn't a new top-tier contender will emerge, but it will be. So what if Sui becomes the Solana of the next cycle? This isn't just wishful thinking, it's a scenario based on technological succession. Solana captured the last cycle's zeitgeist with its high throughput. Sui aims to take that a step further with its parallel transaction processing, a fundamental architectural advantage that could attract the next wave of demanding high-volume applications. And what if institutional capital, after years of battle-testing Ethereum's solidity, finally chooses the security and formal verification features of the Move programming language? For large funds, where a single smart contract bug can mean billions in losses, Move's safety-first design is an incredibly compelling proposition. To enter millionaire territory from this investment, the scale of this success needs to be monumental. We need a $40 to $50 billion market cap. That puts Sui firmly in the top 5, alongside the titans of the industry. This valuation implies it has captured significant market share in DeFi, gaming, and enterprise adoption. Factoring in token emissions, at a $40 billion market cap in 2026, the price per token would be roughly $8. Now for the cold, hard math. To reach a $1 million valuation at that $8 price point, you would need to hold 125,000 SUI tokens. At today's prices, that requires a substantial upfront capital allocation of over $100,000. This immediately reframes the opportunity. The 100x microcap dream of turning a few $1,000s into $1 million? That is not statistically probable here. This is a tanker, not a speedboat. It's a bet on large-scale infrastructure, requiring significant capital for a life-changing return, more akin to a strategic venture investment than a lottery ticket. So, is Sui a failure? Absolutely not. It is scalable, innovative, and technologically elite. But this is not a lottery ticket. It is a calculated percentages game. You are betting on real-world adoption, institutional scale, long-term infrastructure. Revolutions don't ask permission. They scale quietly. But your portfolio must be built on math, not just hope. If you want analysis rooted in infrastructure, not hype, subscribe and stay sharp.